All right, we're live, Jake, and welcome everybody to a very, very special episode of the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and I'm here today with my dear friend, Jake Breen, MBA, real estate investor, broker at Berkshire Hathaway Home Services. And it was funny, Jake and I were just kind of talking about, his a difficult transaction, a difficult commercial transaction that he put together. And he really does have a superpower for two things that I want to give him massive credit for. Number one, he is a data and analytics just savant would be probably the right word. Like, this guy understands the trajectory and the market and data better than anybody I've met before. And number two, he has an incredible ability to keep together really difficult deals. It's crazy, Jake. They all get difficult, don't they? Even the easy ones get difficult.
That's why we still have jobs, and we have not been automated by machines.
That's it, brother. That is it. So today, and I say this is a very special episode because this is really two dudes that just like hanging out with each other, talking about real estate and telling a story. And the story that we want to tell today is this story around a new building that Jake and I bought. And I bet we could come up with a picture here in just a minute for those of you that are watching the live stream. Actually, I've got one right here, Jake, that I'll share just so everybody can kind of see what I'm talking about. There we go. Okay, cool. Let me just share my screen. So this building is a medical office building, and it is in the fastest growing suburb of or county of Utah. This building or this county is growing. Last time we checked, when we were doing due diligence on this property, 4 times the population growth as Las Vegas on a percentage basis. This area has a lot of older members of the community. It's not like their birth rate is 4 times the fast as Vegas, but they're a real second home destination, and the economy is just really booming. So the undertone of this, or the why behind this podcast, we want to tell the story of this building, how we acquired it, how we went through our due diligence, what we did to separate fear and emotion from, as it relates to what's happening in the real estate market right now. I mean, I don't know if you've ever seen more negative news than I've seen in the last 3 months about real estate. So how do we compartmentalize that as real estate investors? How do we stay focused on the data and come to a sound investment decision? So, Jake, with that, where would you like to start, or what would you like to add?
We were excited to get into the specifics of the deal, but I think we've got to set a little bit of framework where you just wrapped up. I think we need to paint the picture of a little bit on 2 sides of the coin. One, what economists and experts are saying about the market and projections. And then the flip side of that, which Josh and I often talk about, this is the education from the streets, so to speak. And just want to add that one of the things that I think keeps us very relevant in this industry is that both Josh and I are still actively producing. So we hear it from both sides. We read data and articles and experts that do know what they're talking about and have a good history in predicting where real estate's going. But we're also meeting with customers and clients on the daily, and we know we have a sense for what the average consumer is thinking or feeling and the questions that are hot topics right now. So I think before we show you why we still made one of the largest purchases in our career in this market, and this is fresh, guys, this is just in the past week, why we still closed this transaction with all that fear mongering and anxiety around doing a transaction is out there right now.
Yeah, and I think that's a great place to start, Jake. Let's start there. Like, let's not fly over the fact that there's a lot going on in this market, and so let's talk a little bit about that, what we're seeing. So we're seeing a shift in well, let's start with inflation, because that's really the, what is pushing interest rates higher. We're seeing the highest inflation rates we've seen in 40 some odd years. There's a lot of fear around inflation. Inflation is the primary reason why we're seeing mortgage rates, both commercial rates, which are more based on the 10-year US Treasury, but also residential mortgage rates, which are based on mortgage-backed security trading. They're both, the direction of those are both dictated by inflation. So I'm just going to nail down on that just a little bit. If I'm a bond investor, let's pretend I'm buying one of these commercial mortgage bonds or one of these residential mortgage bonds, and I'm going to get paid 6% or 5% to buy that bond. I'm giving money that you're going to use as an investor to buy a property or a building. I have to be thinking about what is happening with inflation, because if inflation is moving at 9%, but I'm only making a 6% return off my investment, that means I'm actually losing 3% in purchasing power each year. So as inflation goes up, so does mortgage interest rates. As inflation comes down, so will mortgage interest rates. So the big thing that is causing this overall shift in the market is that inflation has gone to 40-year highs. Interest rates have had the fastest doubling. In fact, I think it's the only time interest rates have ever doubled. Mortgage rates have doubled in 6 months.
Yep.
And that's causing buyers to look at their payment and affordability. On the residential side, they're saying, whoa, time out. That house isn't affordable anymore. On the commercial side, we had to deal with this, Jake, mid-transaction. We're going, wait a minute. Our cash flow just got eaten up. So those are all legitimate fears, but let's talk a little bit about the benefits of inflation, because, and I'd love you to tell this story, like what happened mid-transaction on this that really made it so this was a deal in spite of the fact that interest rates went up throughout the transaction.
Yeah. Well, and what you're alluding to, guys, is a principle in investing. And you've heard it from Warren Buffett and a bunch of books. And I'm going to paraphrase because I'm always just putting things in layman's terms for the average individual to understand. That's kind of my forte. I'm really not that well read, but I can put these principles in street talk. So the reality is it's always a little more complicated than people assume. Let's take the average home purchase. And through your analogy, you just went through an inflation. People go, well, I was shopping when interest rates were 3.75. Now the rates, let's say 5, and pricing hasn't really gone down. And so the payment's going to be $1,300 more a month. And so either I'm out or I'm not moving, or this is what we hear all the time, I'm just going to wait for it to crash. And because rates went up, I'm going to directly correlate that to pricing coming down. Now, this podcast is not about that. So we have many other presentations that go at that and kind of teach the fallacy in that. But the point I'm trying to make is it gets much more complicated, and there are way more factors involved in your investment analysis. And Josh, one of the things we see when we have inflation and your interest rate goes up, at least on the investment side, is usually rents are raising at that same time. In fact, statistically across the nation, across all real estate categories, where you're looking industrial, office, medical, whatever it may be, in all of the recessions, except for residential in the Great Recession for a 3-year period, all of the other past 6, rental prices have increased through that time frame. Now, there's other factors like vacancies and what you see. So on our transaction, mid-transaction, we found out that our long-term interest rate on our commercial loan was going to go up a bit. And that small bit eroded about 30% of what we would net in cash flow. Significant. It wasn't a large number, but as a percentage of income, it made us go, we no longer want to do this deal. But then we were also able during escrow to negotiate lease renewals with what's called CPI index increases so that we protect ourselves. And we did all this in due diligence, which that's a whole nother thing. That makes you feel a lot safer before you actually close. You're not crossing your fingers. You're going through the transaction saying, all right, we can maybe still stomach this rate increase if we can lock in these future terms. And we were able to successfully, one of them came down to the day of a significant amount of money going hard, but we were able to get all of those signed before we risked any sort of significant amount of money, and then put those new projections in our deal. And that actually made up the entire loss in cash flow plus $1,000.
Yeah. So those of you that are listening on the podcast, this is going to be a graphic heavy conversation because we're going to share probably a good number of graphics. So you may want to pivot over and check this out on our YouTube channel, which we'll of course link to in the show notes for the podcast. But I did want to just show, to your point, Jake, I was just looking at this the other day. Most people, and this is a presentation that I do for real estate investors, so that's why they have the different strategies across the top. But most people are super aware that home values are up 19.8%. This is according to Zillow, June 2021 to June 2022. We're looking at a 19.8% increase in home values. Most people are aware of that. But what a lot of people don't understand is that rents are just a little bit behind that at 14.8% increase year over year. So lesson number one that we took away from this transaction was, look, prices are still elevated. Interest rates are going up. At face value, that makes a more challenging environment to find a cash flow positive property. But don't let that stop you. Like, we had to have a meeting where we said, okay, dude, break down the rent roll for each of these tenants. When are their leases expiring? What is their rent increases based upon? In the commercial world, we were lucky enough to have leases in place that were fixed for 5 to 7 years. But each year there was a clause that would increase that initial rent amount. The clause said it's either a 3% annual rent increase, or it's matched to what Jake alluded to, the CPI index, which is just a measure of inflation, consumer price inflation index. And that's at 9.1% right now. So at current rents, at the price that we negotiated with the interest rates going up, did this deal make sense? Was it enough cash flow? The answer was no, it didn't. It didn't make sense. And we were ready to walk until we dug a little deeper and calculated those and went, holy cow, we're 3 to 6 months away from this deal making all kinds of sense in the world. So
our bottom line on this transaction, we'll get into some of the spreadsheets, increases between 12 and 14% net revenue by this coming December, January. And the greater point Josh is bringing up is really a massive lesson in investing, and it's really pertinent in this market. And I've been in this career long enough to see this type of environment twice. There's different factors, but this type of environment twice, where we all kind of know that rates are up and it's going to cost you a little more to loan money, but at least in our market, it's not bad enough to have pricing decline yet. So a lot of people are just saying, I'll wait for prices to go down. And we have a lot of reasons why we don't think that'll happen. But that makes it so that you have to be a little more crafty. Now, most people that were in escrow in our situation would have either A, canceled, or B, gone back to the seller and tried to negotiate a lower price. Now, what does a seller say when you come at them and say, now that our interest rate has risen, we need a better price on the property? I mean, the answer is always no to that, just in case you haven't experienced that. They don't care about your interest rate.
It's emotional at that point.
Yeah, and you negotiated a price and you're locked in contracts. So that doesn't work. You could maybe attempt to get a little money in due diligence. That's kind of coming back. But suffice to say, you have to kind of dive into these other factors. And I think these are the factors that a lot of people forget when they're going to make a purchase. They're just like, price, interest rate, cash flow. And then, oh, that's not up to snuff, I'm out. We've made crafty purchases where there's a lot of other options that increase your bottom line.
Yeah, you got to get creative. But, I think to your previous point, Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. Mm-hmm. And we're starting to see people get fearful. And that makes me go like this. All right, I got my sonar out now. There's somewhere somebody's going to misprice something, and I want to be the someone who finds it. And in this particular transaction, we felt we found it not on the surface level data, but on the subcontext data. So that's a first takeaway. Let's go back to a few of the headwinds and the emotional things that we had to work through in this deal, Jake, because I think it was really interesting. So we had inflation hitting 40-year highs. We had interest rates essentially double while we were under escrow. Now we were able to lock in less than a doubling, but this is happening in the world of real estate. And of course, now you've got all these headlines around, okay, well, this is going to lead to a real estate crash. We got to compartmentalize all that stuff and deal with it. Jake, there's this reverse wealth effect that's going on right now. I'm going to share my screen again. This is about a month old. This is from the beginning of July, but the reality is people are less wealthy than they were 6 months ago or 12 months ago, us included, because our assets, a lot of our, cryptocurrency, bond investments, stock investments, a lot of the value of those assets have gone down. And it's a concern, it's one of those things that weighs on us as an investor. So this is a map for those of you who can't see it. It just shows performance from December 31st, 21 through July 11th, 22. And it showed that through the most recent data that we had at the time, real estate was up 7.9% just in the first, 6 months. U.S. Treasury bills down 0.9%. The bond market was down 10.2%. The S&P was down 18.5% at the time. And cryptocurrencies at the time were down 65.97%. So don't forget, we're making this decision in a brutal first half of the year in terms of the overall wealth effect. So we had to compartmentalize that.
Let's get a little personal on that for our listeners too. Both Josh and I are invested in cryptocurrency. I had sold about a third of my portfolio right around peak to invest in another building we bought. Held on to the other 2/3, watched this ride down, and per his quote he just mentioned about Warren Buffett, on 4th of July weekend, just a month ago, I started repurchasing. And nobody told me, I didn't necessarily read some guru's advice. I just went, yeah, this is really low. And I don't know if I've timed the bottom. It's not what I do professionally, but I do know that when everyone's fearful and something's gone down, but I believe in that product long-term, I'm going to buy back in. So I did that in crypto, but guess what is the tried and true asset of all time? And the entire globe is real estate. So I believe in that product long-term.
Yep. Yeah. Well said. And the last headwind that we had to deal with emotionally as investors is it became super clear that the Federal Reserve was on a path of raising the Fed funds rate, not to be confused with mortgage rates. We need to make sure that people understand those are very different things. But the Fed was raising Fed funds rate to stymie demand, to bring down inflation. And it is highly, highly likely, based on history, that when the Fed raises rates to slow the economy, we end up in a recession, something breaks. Somewhere there's a weakness that's exposed and somebody doesn't perform. It's a Lehman Brothers event is going to happen. So we're dealing with that, 2 quarters of slowing economic growth. And so I think this is a great place, Jake. We've talked a little bit about the building we bought, the fear that we had to deal with and compartmentalize, how we had to dig a little bit deeper to make these numbers make sense. Let's go ahead and go through what was our due diligence, our due diligence or evaluation of the deal. And if we can, Jake, let's do this because you're a numbers expert. If I could explain it from my perspective first, and then if you can go into the cash flow aspect and share your screen, I think that'd be really good.
Cool. Let's do it.
All right. So the first thing that I think about there's really three things that I think about when I evaluate any real estate investment. Number one is supply and demand considerations. So if I think about this particular property, it is in a metro that is growing 4 times as fast, as I mentioned, as Las Vegas. We're buying an asset class, which is medical office space. And the average person that's moving into this metro, into this county, probably more accurately, is a baby boomer. So they're going to have more medical visits than a millennial. So not only is the population growing, but it extremely quickly, but it is growing with the age demographic that is likely to frequent a medical office building. Okay. Warren Buffett talks about this as sizing up your headwinds or your tailwinds, right? Like you're a sailboat, right? Is there more wind pushing you forward, or is there more wind pushing you back, more resistance pushing you back? So these are tailwinds. I've got an economy that is exploding with jobs. Unemployment rate is like 1%. The average hourly wage in this county is growing amongst the fastest in the whole United States. We've got the demographic increase. We have the right age group. And then it comes down to, so that's all demand factors. Now we get to supply factors. When Jake and I looked at this building, we said to ourselves, okay, how much would it cost to buy this land? How long would it take to get it entitled? How long would it take to improve the land? How long would it take to build? What do we think the relative costs of construction are now? And how much do we need to factor in for variability? Because supply chains are screwed up. You can't find labor here. Builders are booked forever and a day out. We can't lock in costs. Like, what would that look like if we were someone trying to bring new supply to this market? And we looked at it and we went, we would never do that. Like, there is no way on God's green earth we'd stick $1 million in a piece of dirt, spend 6 months going through the city, have no idea what the cost of inflation are to build this building. Like, would we ever do that? No, we wouldn't do that. Okay, cool. Well, that means other reasonable people are probably saying that same thing. So what does that say for supply? There's probably going to be very, very little supply coming online. Jake, I'll turn it over to you.
Yeah, I'm sharing a screen, which is just a summary of our macro level, let's say demographic or due diligence study. Now, just a couple notes to add to what Josh was saying, which is spot on. I have worked with some big REITs, some large companies that have a budget where they hire people for a demographic study. So they say, we want to open up an assisted living center or a hospital or an urgent care center or a new storage unit. And they hire the best experts in the United States to do a demographic study. You're going to spend between $5,000 and $15,000 on those. Okay, I'm not knocking on those companies. Josh and I have never hired one for our own purchases. And here's why. I do feel pretty darn confident that you can find the numbers that I have in this summary pretty easy on your own if you're interested in investing somewhere. And it's the things Josh mentioned, so I won't be redundant, but it's like population growth, area median income, labor accessibility, cost to build, cost of land. And if you're investing in a certain asset class, find out how much of it exists, how much of it is leased, and how much of it is coming on market moving forward. And I would say the biggest factor we discovered here, we already knew Washington County was like fastest growing zip codes in the United States and all these great things. What we didn't know is that office space, which a lot of people are fearful of office right now. They've been fearful since the starting of COVID because they said everybody's going to exit office. And we've bought office during COVID. Here's why. It's the build cost factors that Josh mentioned. And so over the last 5 years in this entire county, only a grand total of 230,000 feet of office space has been delivered. That's very little. That's like 4 or 5 buildings. And they're essentially 100% leased. And it's pretty easy to go back in history too and just kind of see where the rate at which rental prices have been increasing. So we knew all these things were positive for this market. We also knew that it was impossible to build something and compete with the pricing we were shopping and construct a similar sized building. But whenever you find those factors, I'm going to tell you the negative thing you're going to find. You're going to have a really hard time finding an asset to purchase when those are the factors, because others know about it. So you've got to come up with some other ways to shop, not just looking at what's on the market. And this was an off-market deal.
That'll be an interesting dovetail. Let me just close out this thought, and then let's go back to that real quick, Jake. So first thing I think about is supply and demand. Is there going to be more demand than supply? And as I go through all of that research and due diligence, I'm 100% sure, not 99, 100% sure, based on all that data, that there is more demand than there is supply coming to market. Cool. I've checked that box for myself. That's box number one. Box number two is cash flow. Jake's going to get into that, because I don't care how good the supply and demand are. I'm not parking my life's energy. That's how I think about money, in an asset that doesn't pay me for my life's energy. That is ludicrous to me. So, and that's how people get hurt in the real estate market. They make decisions based off of wonderful pontifications of future appreciation, right? As soon as you catch yourself doing that, get ready to get burned. Cash flow. So we got to get the cash flow, which Jake will break into. And then the last piece, so it's a three-part process: supply and demand, cash flow, and then tax benefits. So Jake, if you'll hit the cash flow analysis, and then I'll jump into just a high-level overview of how the tax can benefit if you qualify.
You got it. So now we're getting into specifics, guys. I'll narrate. I have this zoomed about as big as I can to give you a general idea of the deal. This is a Class A medical office. It's about 37,000 square feet in Washington County, which is southern Utah. Our purchase price was $12.1 million. You'll often find in commercial assets like this, you're having to bring at least 30% cash to closing. Our leveraged ratio is just under 65%. As mentioned, our interest rate went up a little bit during escrow. And so, the payment's a hefty $41,000. I'm going to toggle over to rent roll for just a sec to give you an idea of that. There's a lot of little things I could say that we've learned about your tenant profile and how we like to divide up the building and what we like our leases to say, and how we increase rents, as Josh mentioned earlier, with 3% annually or CPI index. Well, this is a general overview, so we don't have time to dive into those specifics, but this is the rent roll that we analyzed during due diligence. Now, this has changed with those lease updates and stuff I mentioned, but I want to show you what we had to go off of when we were still deciding whether we would purchase or not. And kind of the few things, let's say a couple of things that stand out that you really want to look at if you're just not risking any money yet, but you're starting to spend your, as Josh mentioned, your life's time into analyzing a deal. It's not just how much is it bringing in and what am I paying? It's more complicated than that. You really got to dive into the leases and know when people are terminating and when they're going to renew and the condition of their space. And we learned pretty quickly that our largest tenant was going to be expiring by the end of the year and had the oldest conditioned space in the building, which means in commercial, it's highly likely if that tenant renews, which we wanted, we didn't want any vacancy and we didn't want to move them. When they renew, you're probably going to have what's called a TI expense, tenant improvement, and you're going to have to put money into the asset to have them stay. So this, when we analyzed it, was bringing in about $60,000 a year in rent. The second factor I really think you need to pay attention to when you're doing a quick analysis of especially commercial assets is what's called CAM charges. Okay, this is common area maintenance is the acronym, but I've found in the commercial world, they use this far too loosely because it is different on every single asset we've ever looked at. Why is it different? What am I getting at? Well, CAM reimbursements, the amount of extra rent, let's see it this way, that the tenants are paying to cover the common area spaces, the entrance, perhaps the landscaping, perhaps their share of utility bills, perhaps their share of internet. I'm here to tell you, it's not analogous across all commercial assets. It's different in every building I've analyzed. Some say your CAMs are prorated on your square footage. Some are extra prorated based on how long you've been in the building or how long your lease commitment is. Some have certain things that are paid for and covered by the landlord, like property tax. Other leases I've read say that the tenants reimburse for that. So here's the second area Josh and I have made a lot of money on investments, is reading that fine print, knowing what we're doing and going, this current owner we're buying it for is not accurately charging in CAMs. And guess what? When we were new to this type of investing, we didn't know that either. And we probably stepped over some dollars to pick up dimes trying to increase rents when we could adjust CAM reimbursements and add significant dollars to the bottom line. So analyze leases, understand your CAM reimbursements. All said and done, I'll toggle back over to our, just what we call our master analysis sheet for investments. All said and done, rent was bringing in about 60 grand a month when we analyzed it. CAM reimbursements were about 13,000. And so we were looking at an effective gross income of 78,000 a month. Okay. Again, payment was 41 grand. So if you scroll down here, and I'm going to mention before I tell you this number, this is our 9th commercial purchase. And truth be told, yes, in analysis, this was the skinniest deal of all 9. So no doubt with all the other economic factors and headwinds Josh mentioned, we were nervous about it. We should be candid with you about that. But numbers don't lie. And at the end of the day, we went, all right, this is going to cash flow $20,000 a month. For those of you that are running the math, $4 million out of pocket for $20,000 a month, yeah, it's relatively skinny. You don't want to have one problem. You don't want to have one expense repair, a lawsuit, an insurance claim, one tenant leaving you, else that's going to absolutely destroy your cash flow. But, and I'll finish here, Josh, but if you're that narrow-minded, I'm telling you, you'll do like I did the first 10 years of my career, and you'll kind of spend all this time and cancel every deal that you have in escrow because you'll scare yourself. You'll get too nervous because here's the next set of factors you really got to consider. We just went through as is. Now I'm going to show you what's to be. And you got to shift gears from as is now to what it's going to be in the future. And I'll let Josh cover the tax part, but I'll give you a quick idea of our 10-year projections on this. And this is just our nature. Josh and I go very conservative on 10-year projections. I'm very conservative on appreciation. Every deal we've ever held and sold has done better than we've projected as far as appreciation goes. But it's pretty much this simple. With those rental increases that we mentioned, either 3% a year or CPI, yep, we're increasing rent 3% every year. So, and note, all your fixed expenses are covered at that point. So that 3% increase on the rent of $65,000 a month is dollars that go straight to the bottom line.
Yep.
Right. So we're adding about $20,000 a year to the bottom line, and perhaps quite a bit more if CPI stays increased like it is. After 10 years, with just an assumed 3% annual appreciation, keeping up with inflation, which is so conservative. The last decade's blown that out of the water. But with only 3% appreciation, after 10 years, should we sell the asset, after we pay off the loan and everything, we'd net this number, 10.3 million. And that is a 14.41% annualized return, 14.41% every year for 10 years after you factor in building appreciation and rental increases.
So Jake, before you close that down, masterfully explained, will you go over to your rent increases? Let's assume appreciation. We've had such a massive run in appreciation. Let's assume that that we don't have outsized appreciation going forward. We just stick with 3%. But
Yep.
let's assume that the economy is still driven by this inflationary forces, and now the rents go up by 6% instead of 3%. Right now, all those rents this year are going up by 9.1% currently.
Yep.
But if we had a rent increase over the next decade at 6%, what would that do to your internal rate of return?
It's funny you asked that, because I just adjusted it while you were asking. Before, our annualized gross income right now, year one, with rents and CAMs, is $775,000. And before I just changed the spreadsheet, assuming only 3% increases, in year 10, that gross effective income was about $1 million. So over 10 years, it goes up 250 grand. Okay. If we now up that rental increase factor to 6%, we go from 775,000 gross effective income year one to 1.387 million in year 10. That's 6% rental increases. And if we remove appreciation, that has us at a 14.96% annualized return, almost the same as before, but that's if we sold the building for what we paid.
Yeah. Wow.
Right?
That's incredible.
Yeah.
Great. Thanks, Jake. Really well done. There's a question on one of the live streams that we're doing, Jake. What type of lease are the tenants in? So these commercial leases have a 5 to 7 year term, depending on, and some of them might be as long as 10 years, but they have a covenant inside the leases that ties an annual rent increase to either 3% automatically or whatever CPI is. So, one of the things we tell real estate investors and clients is real estate is the ultimate inflation hedge, because, as I showed in the previous graphic, other asset classes tend to get slaughtered by inflation. Real estate prices tend to continue to go sideways or up, but rents go up with the pace of inflation. And it might not be lockstep, but if we look at what Zillow said, increase in rents year over year from 21 to 22, they're reporting 14% increase in residential rents. Our leases are tied to CPI that went up at 9.1%. So we really have a strong hedge against inflation, whether you're in the residential or the commercial world, as long as your leases allow you to adjust annually.
Yep. Great point.
Yeah. Okay. So Jake, the next thing, so I said there were 3 things when we evaluate a deal: supply and demand. Jake walked you through how we analyze cash flow, not just from a current perspective, but from a long-term perspective. We're looking out over 10 years. And then the third thing is tax deductibility. And I have a presentation that I've been doing for real estate investors that I'll bring up on the screen now that will kind of help walk through this point. Anybody who doesn't know about tax segregation studies, get ready to have your mind blown, because this is game-changing stuff. So I'll actually go back. These are 3 buildings that Jake and I and my mother and my wife and a few other of our partners purchased in 2021. So we bought a medical office building in Taylorsville, Utah. We bought another medical office building in St. George. We should make sure we hit the story, Jake, of how we found this second building. And then we bought this retail space. So, this has major tenants like Big Five and GameStop,
Old Navy,
and Old Navy, And so we bought those 3 buildings in 2021, and there is this tax advantage factor to real estate if you qualify. And so I'll give you just a high level overview. This was actually the bid that we got from the Cost Segregation Authority. That's a company who comes out and does these cost segregation studies. These studies allow us to pull forward the amount of depreciation or tax deduction that one can take on their tax returns from the real estate that they own. So just to kind of walk you through this here, the first thing that the tax segregation study does is they take out the value of the land, and they say, okay, your depreciable basis is the value of the property minus your land. So here's your depreciable basis. depreciation is a concept that the IRS gives us that says, look, we're going to assume that a building has a certain economic lifespan, and that at the end of that lifespan, you're going to have to rebuild the building. So if that's the case, then you can depreciate or devalue, i.e. take a tax deduction on your tax returns each year as the building is devalued or depreciated. There was some tax code changes in 2018 that said, hey, you can actually pull forward that depreciation. So instead of taking it over 27 and a half years, you can pull it forward, and commercial and residential has a little bit different number of years you can depreciate over. But instead of taking over a long time horizon, you can pull it forward into year one and stack your tax deduction. So in year one, I'll skip to the punchline team. In year one, we were able to pull $4.85 million worth of depreciation forward. That is an offset for your income. So if in that year, our partners had, let's call it $5 million in income, then they would have been able to take a real live tax savings in that year of 1.7 million. So, the title of this, of this presentation that I give is, or part of it is, you either invest in real estate and know the laws around tax depreciation, or you pay taxes, but you don't have to do both. The IRS gives you an incentive to invest in that real estate. Now,
it's important to note on that 1.6 too, guys, because I confused this myself for years. That year one tax savings is dollar for dollar. That's not a $1.695 million write-off.
No.
That's you either pay 1.695 in tax or you save 1.695 by buying these buildings.
Sure. Yep. And if you can't use all of that write-off and because your partner's income isn't that much that year, you can roll it forward. So there's some advantage there. Now, listen, I'm not a CPA. Jake's not a CPA. You need to check with your tax advisor, but there are some phase out rules that the IRS has that says if you make over 150,000 a year as a couple, you actually can't use that depreciation unless you meet both of these qualifications, either you or your spouse. You have to spend more than half of your time in the business, and you have to spend at least 750 hours. And it has to be your primary trade or business. So, you may meet with your CPA and say, well, that's great, but you don't qualify. Your wife doesn't qualify. Your husband doesn't qualify. Your spouse. There's also some other carve outs. So those of you that are going, shucks, I'm out of luck. There's actually another carve out that allows you to use depreciation if you have short-term rentals. So if you meet this definition, which is you participated in the activity of renting out your short-term rental for more than 100 hours during the year, and you participated at least as much as any other individual, including cleaners and landscapers and maintenance people and managers, then if you meet this definition and you haven't used the property for more than 14 days, then you may also qualify for that depreciation. So just be aware, when we're thinking about this return, Jake's showing you a 15%, it's called an IRRL, internal rate of return. That's the total return over 10 years. That's exclusive of the tax benefit. So let's say that we saved, we had a 14% rate of return year one because we had cash flow, amortization of the loan, appreciation of the property, but then you also took 40% win because you didn't pay taxes on any of your income that year. It washed your income. Now you're talking about a 55% rate of return year one. That's pretty freaking incredible.
Yeah, there is truly, when you factor in tax, especially with these, I'm being facetious, but I call it Trump tax code because there was a lot of flack for some of these things that were passed. But then every big investor I knew of, especially the REITs, immediately took advantage of these tax savings. And trust me, the large companies that invest, they have staffed employees who are experts, who are in charge of reading this code. And the biggest factor in most of their purchases is tax advantage or tax savings. Okay. That's why you always hear about the term 1031. It's a big, big deal. And I've worked with a lot of these REITs and seen their internal documents. And I'll tell you, they've got all these wild spreadsheets built for tax advantage. I know a lot of our audience, including Josh and I, back to that analogy, we're from the streets. We've kind of learned and created as we've gone. And I realize that most people aren't hiring an employee to be a tax expert. But let me wade through all of that kind of minutia for you. It's as simple as the graph Josh just showed. And there are quite a few ways to work around getting that cost segregation analysis and that tax advantage. One simple thing we've done with two people on my real estate team is have them go through the motions of getting an active real estate license. So it's a little bit of effort, a little bit of schooling, pass a state exam, and then immediately declaring them on inactive status because these people have other day jobs, but they are investing in real estate. And that way you've just checked another box with the IRS, you're an active real estate professional. And then it's a little easier if you ever get audited to kind of go through your justification in owning your own rentals and running them yourself, and you have a real estate license, et cetera, et cetera. So that's just one example of ways that you can take advantage of this. If you add, this is the last thing I'll say, if you add that tax saving, and the reason I don't do it in our master analysis spreadsheet is because the numbers get crazy. It's like nobody's going to believe when you tell them that you're going to have a 56% annualized return on your investment. It's just kind of crazy talk. But I helped Josh transfer a lot of what was his old residential portfolio, and I personally saw the numbers of a lot of these sales as he transitioned a little more into commercial, and those were returns on a lot of these assets, 50, 60, 70, 110% over a rather short period of time, 7, 8, 9 years.
Yeah, well said. And so I just kind of like to summarize here, because we've got about 5 minutes left, Jake. In spite of all the headwinds that we're seeing in the market, we have to do the deep dive into the analysis. We can't be paralyzed by the fear because, as Warren Buffett reminds us, the greatest opportunities are when everybody else is paralyzed by the fear. Mm-hmm. So when we looked at this, we're saying, okay, we have a highly inflationary market, which is pushing up rents very quickly. As rents are going up very quickly, the feel or the real relative payment on the debt, it's like it's being devalued by inflation, because as the rent goes up and the income goes up, the pain of making the payment every month is less and less significant. So that inflation is actually a benefit to us once we understand how it moves rents. Second of all, there's a recession coming. Now I'll just quickly do a really quick screen share here. And a lot of people can get scared by that. But team, look, here's what happens to mortgage rates in recessions. 1980 recession, in 6 months, interest rates went from 16 to 11.8. That's a 4.2 decrease in interest rates in 6 months in the 80 recession. In 81, 82, interest rates went down 5%. In the early 90s recession, interest rates went down 2.2% in 8 months. In the 2000 recession, interest rates went down a little less than a point. What are we, 0.8 there or 0.6 there, something like that, 0.6. In the Great Recession, interest rates went from 6 to 4.9%. In the COVID recession, interest rates dropped a full point in 2 months. So yes, a recession sounds scary, but what happens in recessions? Mortgage rates go down. We're going to refinance the property. We're going to increase the cash flow. So we need to think through those implications. We talked about the benefits of tax deduction pretty well. I think the last thing that we should end on here, Jake, is this thought process of those who buy and wait are more wealthy than those who wait to buy. And I want to pull up a chart here. This came from a podcast I did recently. Okay, yeah. So this is a long-term graph. This quote came from Brian Grimes, who's the CEO of 24/7 Cash Flow Academy. Brilliant dude. Did a podcast with him in the recent past. And Brian so aptly put this into context. Those who buy and wait are wealthier than those who wait to buy. And if you're looking at the screen right now, Jake, you see my screen okay?
Oh, yeah.
Okay, cool. This is a 30-year look at cumulative home appreciation from 1991 to 21. And the national average, this is residential, the national average is 274% appreciation. In the great state of Utah, it's 556% appreciation. But team, check this out. That's 556% appreciation if you paid cash. If you put down 5%, your appreciation rate over that 30-year period is over 11,000% because you used leverage. The whole value of the asset appreciated, but you only had to put down 5% or 20%. So Jake, I'll turn it over to you to close us out in the 2 minutes we have left, my friend.
Yeah, here's what rules the roost. I have been asked by smart clientele many times, it's one top 3 questions I've had in my career, is how can you real estate sales folk out of one side of your mouth say it's time to sell, and now the other side advise people that it's a great time to buy? And for years I struggled with that. I went, yeah, that's kind of contradictory. How can it be a good market to do both? And it wasn't until, and I've said this many times on podcasts and videos Josh and I have done, but it really is the best easy street analogy for everyone to understand. It wasn't until one day my good buddy Josh here said to me, look, man, after 20 years, I don't know of any deal, and he's bought well over 100 deals. I don't know of any deal ever that I went to buy at the time I didn't think I was overpaying or getting ripped off or, whatever it might be. We all feel that way. And what separates the cattle from the trough, those that succeed and they don't wait to buy, they buy and wait, is simply getting yourself over that. We all have those preconceived notions. We all start reading too much. We all listen to Crisis News Network here or there, whatever your methodology is. It's getting down to the facts and realizing what the future can hold and just making that conscious decision and acting and making the purchase. Because guess what? We have 100% history in the United States of America since its founding that if you just hold on, time will heal all wounds in real estate, even if you bought at the peak. So yeah, unfortunately, it is always kind of a good time to buy. You need to buy it and wait, not wait to buy.
Yeah, well said, man. Great way to close us out. Thanks for doing that so strong. So team, overriding takeaway, the fact that people are getting fearful around the real estate market is great for investors, but don't buy without doing the due diligence. Check your supply and demand, check your cash flow, analyze your tax benefits, and don't go with a hunch or an assumption there's going to be appreciation. You have to do it off a strong foundation. But once you've done that, you've checked those boxes, buy confidently and hold long. All right, Jake, I think that's a wrap. Thanks, everybody. It was an absolute pleasure hanging out with y'all today.
See ya.
Take care.